I want to dig into this idea of the bid-ask spread, the spread in a security, or really anything. We can stretch this to other commodities or goods outside of the stock market. This idea that the spread is a measure of transactions cost, of the implied transactions cost of a trade. So we're going to look at llamas.com again, my favorite company, and this example where the bid is $99 and the ask is $101. While we're still working through these early examples, stop and think about what this means until this is just built into you. Bid of 99 means someone is offering to buy it for 99, meaning if you come in and issue a marketable order to sell it, you will sell to that person waiting to buy for $99. Where if you come in and put in a market order to buy this stock, you will buy it for 101, because the best ask is 101. The lowest price of someone looking to sell the stock is $101. A quick comment here. The reason that these can't be crossed, the bid, well, there's weird things with exchanges and mistakes that can happen where they can momentarily, but really they shouldn't ever be able to cross. So we're going to say they can't ever cross. If they did, let's say the bid was 99 and the bid was 101 and the ask was 99. That means someone would be willing to buy at 101 and someone else would be willing to sell at 99. Well, if that's the case, they should transact with each other. They match with each other and those orders go away. And then let's say we're left with someone that wants to buy at 100 and someone that wants to sell at 100. Well, then now those orders will transact with each other and go away. And we're left with, once again, this case where the bid is lower than the ask. Okay, so the midpoint price of the security is right in between 99 and 101. It's 100. And you can do this formally by doing bid plus ask divided by 2. That gets you the midpoint between the bid and the ask. Now the spread in this case is just the difference between the bid and the ask. You'll hear this word thrown about a lot when traders talk about stuff. The spread is $2. The ask minus the bid. Now what if we want to talk about the spread in terms of percentage? In fact, I think that's more useful. $2 is a tremendous amount for a stock that is $10, right? If you could buy the stock at 11 and sell it at 9. For a stock like Berkshire Hathaway, which is tens of thousands of dollars, $2 is like nothing, right? It's very small. So let's get things in terms of percentage. Now to do this, you just divide the spread by the midpoint price. So in this case, the spread is 2%, right? $2 spread divided by the $100 midpoint. Thus, if you make a round trip transaction, if you buy and then sell the stock, you're losing $2 per share. That's your cost, your round trip trading cost of $2 per share, or 2% of the net value of your position. Your position value determined based on the midpoint price of the security and the number of shares you get. One comment I should make here. This transactions cost stuff is maybe boring to some people, but is possibly the most important thing in terms of trading. If you can trade and understand how transactions costs work, or more precisely, understand when not to trade because transactions costs are high, you're going to do much, much better. My trading is ultra high volume. I'll kind of show more about what I myself individually do as the course goes on, but I trade an absurd amount of volume. Even most like people in the investment industry and traders would look at my trading and be like, this guy is a psychopath. He trades so much. And because I trade so much and turn over my portfolio so much, the transactions costs I pay are ridiculous. They're out of this world. Think about it like this. The stock market, on average, returns, historically, looking back, about 8 to 8.5% per year. On average. My percent I pay in transactions costs because of my trading is 20 or 30% per year. So if I didn't have to pay that, I would be making such a tremendous amount of money. Now, of course, that aside, I think I do a bit better than the market. So even after my transactions costs are taken into account, I feel confident in my trading. But transactions cost is such an important idea that it would be much more profitable for me, for my trading, if I could find a way to lower my transactions cost a bit, as opposed to finding a way to find further mispriced securities. I seem to be able to find mispriced securities fairly well, but if I'm trading, again, like a psychopath, the transactions cost make me pay a ton of money to the bid-ask spread and to my broker also. Two different parts of transactions cost. There's this, which is the implicit cost of trading, the bid-ask spread, and there's the explicit cost where you just pay your broker a commission. Okay, let's look at this example further. So same thing, the bid-ask spread of llamas.com is 99 to 101. Let's say you use a market buy and buy 100 shares, and then immediately you turn around and sell 100 shares as well. How much have you lost? And ignore broker commissions for now. It's easy to add them in if they're, half a cent per share or $7 a trade. You just add that onto this. But for now, let's ignore it. Keep it simple as we can. I'm going to show you two different methods. This is method one. This is the percentage method. The midpoint price is $100, and we said that the spread was $2, right? Or excuse me, well, it is $2, but 2% is the relevant figure here. We said the spread is 2%. So what's the value of the shares we bought? Well, the midpoint price is 100, so $100 times 100 shares is $10,000. Thus, in the round trip transaction, we lose 2%, which is losing $200 in total. So we pay $200 for a round trip transaction buying and selling this. Let's use not the percentage amount, but the nominal dollar value amount. We buy 100 shares and we buy at the ask, right? Because we have a market order to buy 100 shares. So we buy them for $101 each, which is $10,100 in total that we spend. If we turn around and put in a market order to sell these shares, we sell them for this $99 value. So we sell 100 shares for $99 each, so we get back $9,900. If we pay $10,100 and only get $9,900 back, what's the cost? $200, right? And one way of thinking about this might be a little advanced for now, but I'll throw it out there. You can think about it as losing 1% per trade you make. You lose 1% when you buy it, and you lose 1% when you sell it. And that can clarify thinking a bit, because you're like, well, what if the price moves around? What if I buy it now and then wait a month or wait a year and sell it? Still, the best estimate in terms of the transactions cost you pay is the current spread, unless we have reasons to think the spread's going to change a lot. But once again, if you think of, okay, I make one trade now, I buy the stock, the spread is 2%, so for my trade in buying the stock, I lose half of that in transactions cost. I lose 1%. Then when you go and sell the stock later, you can look at the spread and apply half of whatever that spread is. And so if it's still 2%, you lose another 1% when you sell and unload your position, and you've lost 2% overall. Hopefully I didn't just muddy the water there with that extension, because like I said, it is maybe a little bit advanced now, but it should clarify a couple situations. Last comment here with transactions cost. Trading loses you money. When you trade, you lose money to the transactions cost. Thus, you should avoid trading unless you have a damn good reason to trade. If you just trade willy-nilly, like trade randomly, all you're doing is lighting money on fire paid as transactions cost, mostly to the bid-ask spread, but possibly to your broker, depending on the broker setup you have. So I'm going to give you the three main reasons. I'm trying to decide if I can say the three only reasons. Right now, let's just say the three reasons I could think of why you would want to trade. The first is you're so confident that a security is mispriced that even after taking transactions cost into account, the expected value of your wealth is higher if you trade. So essentially, your cost is your transactions cost, but you still make a profit because you're that good at identifying the stock as mispriced. Note, for this to happen, the mispricing in the stock has to be more significant than the transactions costs, right? So in the case of llamas.com, for you to profit on a trade, the mispricing has to be greater than 2% because the transactions cost is 2%. We'll deal with some specific problems addressing that a bit later in the course. Another reason you could decide to trade is because the risk has gotten out of hand. So I'll give you a couple examples of this. Let's say you decided to gamble, kind of for fun, kind of for investment, weird mix. You buy a pharmaceutical company. Historically, pharmaceutical companies don't do super well, but they're kind of like the stock market equivalent of lottery tickets. They can go up a tremendous amount if they find some huge medical breakthrough. So let's say you bought a pharmaceutical company, a little one. You spent $1,000, which was most of the money you had to your name at the moment. Again, not suggested. That's too much of a gamble for most people, but let's say you do it anyway. And this company happens to find the bona fide cure for all cancers. And it goes up 10,000%. All of a sudden, well, you have quite a bit of money, right? You have, how much money would you have? 1 million, is that right? I don't know, it doesn't matter. You have a lot. And the idea here is almost all of your wealth is concentrated in this one stock, which makes you very exposed to movements that this stock has. Like, let's say later the stock might find, oh my gosh, though this stuff cures cancer, it causes Alzheimer's, and all of the people that have the cancer cured. So this might cause the price of the stock to drop down back quite a bit, and you would lose a tremendous amount of money. So you would sell at least some of this stock and rebalance your portfolio so you have less risk because you're less exposed to the news and movements of one individual stock. Lastly, there can be tax reasons. So there is only $3,000 of trading losses, I think it's $3,000, that can be written off each year as if it's income. And if you have a lot more than that, like let's say you have, something like me, like $200,000 of trading losses, this year. My taxes are going to be fun next year. What you might do is sell other securities that you had a gain in, because doing so gives you a tax benefit. Because you're not going to pay any tax on those securities that you're selling for a gain because you have such a big loss to offset them. Okay, quick quiz, and we're going to jump into a slightly different topic, which is more personal practical finance, and talking about Project One, which is the balance sheet project. It is a good body of knowledge that we just got to kind of apply that to some real life situations in real life personal finance. So quiz time, and I'll be back with some balance sheet stuff.